Well, thank you, Nathan and his panel, for setting our panel up so beautifully, and particularly with the last question, because that really is the heart of our panel discussion right now about what are some of the learnings that are happening around the world, and particularly how we're learning from each other so we're not reinventing the wheel each time. So as I was introduced, Jackie Johnson, I'm also on the Global Steering Committee for UNEP FI, and I'm very proud to have many of my colleagues from the Global Steering Committee here too. But on the panel, we've got quite a diverse group of thoughts, and you'll hear from each of my trusty panellists, and you can see all their names on the screen. I won't waste our valuable time by introducing everyone. They've all got very strong credentials to be talking about experience from around the world, but also from different sector presentations. I think the last panel really highlighted the critical need for our financial system to show leadership, but also collaboration. And I can't think of a better example than the European Union with what everyone was facing, and it was mentioned about Brexit, but that panel brought to life how really commitment was turned into action, and I think we can all be in awe of every one of the team that presented and all the action that's happened behind the scenes. This panel is about exploring the different ways different countries are facing into this, but also different actors within the system. And I just want to bring to life a little bit, obviously with my Aussie accent, I'm from Australia, but I did work in New Zealand for a while, so often get misunderstood to be a Kiwi. But I was also talking to some of our Canadian friends who are here as well. And I think for the three countries, we are watching with interest, but we're also trying to accelerate our actions so that we too can have financial roadmaps that guide our economies. So we are very keen to hear from the panellists and really learn. What we did in Australia and New Zealand back in July, we were supported by UNEP FI and PRI and the Responsible Investor Association in Australia and the University of Sydney to bring together quite an ambitious conference where we brought 200 people together, including government and regulators and investors, insurers and banks, to talk about the whole concept of a financial roadmap. Now, there's a lot been happening in Australia for anyone that's been following. We've had a Royal Commission into the financial sector, and we've had a change of a Prime Minister in the time that we thought we would start to enable our roadmap. But what we have got is a published document that came out of our conference and which is setting us up to form our steering group, and expressions of interest are going out over the next week to form that committee. And I know in the audience, I've got my colleagues from QBE and NAB who are instrumental in helping us bring to life the conference as well. So we've seen great collaboration and great leadership across our sector who are willing to take a leadership role, as is our prudential regulator. And I think what we're going to hear from the panel is they are key ingredients that really can take commitment into action. So on that note, I'm going to start with Dr. Ma and actually ask you, Dr. Ma, about the impact on the implementation of China's national roadmap and associated activities. How is that impacting on allocated capital and the environmental outcomes?
Thank you, Jackie. Now let me say that a green financial system, if it's to be effective, needs 4 pillars. The first one is taxonomy, which was discussed in the EU section and so on. The second one is what I call incentive, because some of the green projects or projects with environmental benefits do not deliver very good return. So they need to be incentivized to make sure that the private sector see sort of the reasonable ROE. And the third thing is about disclosure. We need to make sure that investors, the banks, they know which project is green, which project is not green. And the fourth element is about products. All kinds of financial products, loans, bonds, equity funds, insurance, and so on and so forth need to be developed. And in China, the green financial system is designed around these 4 pillars. In 2016, when I was the chief economist of the central bank, I led the drafting of the green finance guideline. And we had all of these things in 35 actions. On taxonomy, in fact, we started it before the guideline. We had a green loan taxonomy in 2013, so we have 5 years of data on green loans. In fact, we show that the green loans default much, much less than brown loans. The NPL ratio of green loans is only 0.4% last year versus 1.7% for the entire banking system, NPL ratio. And taxonomy allows you to develop products, measure performance, as well as provide incentive. And the second taxonomy we provided was the Green Bond Catalog, which was developed in 2015, and that kicked off the Chinese green bond market. In 2016, we became the largest green bond market, largely because of taxonomy. Incentive-wise, we now have a couple of things. On the central bank side, the central bank provides green re-lending facility, which means that the central bank gives you, the commercial bank, cheap money and asks you to lend cheaply to the green projects, thereby reducing the funding cost and enhancing ROE. And another thing we are now pushing, in fact, in the capacity of the Monetary Policy Committee member, proposed to the Monetary Policy Committee that China should reduce the risk weights for green assets, essentially green loans, by cutting risk weights from 100% to 50%. If we can do that, I think the funding cost for all green loans will go down by 50 basis points. It's going to be the most powerful policy incentive in history for green financing. That's something we're now pushing for. The third thing about disclosure, in the 2016 guideline, we officially said that China will introduce a mandatory requirement for listed companies to disclose environmental information. We now have a stage roadmap, which is stage 1 in 2017. We required all the major polluters to report. This year, we will introduce a semi-compulsory requirement. Namely, if you don't disclose, you have to tell the market why. By 2020, every single listed company will have to disclose environmental information, including carbon information, SO2, NOx, COD, energy intensity, and water usage. And on products, it's been done massively at the industry level. We have lots of green loans, like solar loans, and those loans financing what they call green industrial zones, namely the water treatment system is centralized. And we have green ABS, we have green funds, we have green ETF, we have green pollution liability insurance, we have solar insurance, and so on and so forth. So these things popping up like mushroom in the past few years. And the four things, I think, transform the system in a fairly significant way. We now have 10% of loans which are green. And in the past 3 years, 2.5 years, we issued 350 green bonds. And a lot of new products, as I said, are emerging very, very rapidly.
Well, thank you. That's giving quite a lot of us to think about, even on the panel, never mind in the audience. But also, Dr. Ma, we've all been following the Belt and Road Initiative with interest. Could you bring to life just what the efforts have been to mobilise finance to support that initiative, and what are the outcomes so far?
Yeah, in the middle of last year, we, namely the other sort of hat I'm wearing, the chairman of the China Green Finance Committee, we launched a set of environmental risk management initiatives for Chinese investments in the Belt and Road region. And this was signed off by 7 associations, including the Green Finance Committee, the Banking Association, Fund Association, Insurance Association, and so on, telling the Chinese investors and lenders to be greener in their investments in the Belt and Road countries. Now this year, based on this domestic initiative, we're now expanding to international cooperation, which is done jointly between China and UK. In fact, in 4 days' time, I think that's 30th of this month, we'll be launching the set of green investment principle for Belt and Road. It's co-drafted by China Green Finance Committee and City of London, with participating members in the drafting committee, including the IFC, SBN, including the World Economic Forum, Policy Institute, PII, and the Belt and Road Bankers Roundtable. So all these are supporting members of the drafting group, which will be collectively promoting the adoption of these green investment principles. We have actually quite a few major Chinese lenders signed up to the principles already. We're not ready to announce the name yet, but I think sometime early next year, we'll be announcing the Chinese, the UK, and other global lenders, investors who have signed up to the green investment principle for Belt and Road.
Thank you, Dr. Ma. I think that actually raises and answers some of the questions of the previous panel as well about that international cooperation and how we are part of an international market. I think we'll move from China and we'll move to Mako and give us some insight in Japan. Now, Mako actually brings a more interesting view than all of us just sitting in the finance industry, because she's coming from outside the finance industry. And could you tell me how you got involved with the Japanese initiative, particularly from January to June, and what you've been involved in?
Yeah, thank you, Jackie. Hi, I am actually involved in the this initiative. I am talking right now as a secretary of the meeting. There is a high-level meeting on ESG finance in Japan held from this January to June, and we had a meeting 7 times, well, almost more than 1 time a month. It's quite a lot, and that the aim of the meeting was to share the strong will to mobilize the funds of people to the sustainable growth. Just for your information, the Japanese household assets amount more than the $16 trillion actually, so it's a big amount, it's a big money. So towards the sustainable development for the world and also for the Japan, the meeting was held to shift those money to the sustainable growth. And so in the meeting, the experts from all the financial sectors participated in the discussion, including banking and security dealers and pension funds and insurance, and also academics. And there are other governmental organizations such as Ministry of Economy, Trade and Industry, and financial FSA, Japanese FSA, Bank of Japan, and so on. And the important thing is this meeting was hosted by the Ministry of Environment. Sorry. So many key persons, all the key persons around the Japanese sustainable finance are on the table. And we had that meeting, and I was part of that as a secretariat. And I would like to introduce the key recommendation from that meeting. That was, in my words, 3 parts. The one is to accelerate the ESG investment in the capital market. ESG information disclosure in line with the TCFD recommendation should be promoted. And the enabling conditions, so like a platform for such disclosures and dialogues should be prepared. And more financial instruments taking into account of ESG factors like green bond and ESG index should be developed and expanded. And expectation to the investors also there to consider ESG factors into their engagement processes. Make it mainstreaming and encourage their own ESG disclosure as an investors and self-assessment to conduct. And the second one is to promote ESG loans for the banking sectors, find out more opportunities to collaborate with local authorities and find out how they can circulate their money within the region maybe. And invest in the region's sustainable development. This is very important because, as you know, Japan is facing the aging society, and it is very important to keep the regional economy high enough, like not only the Tokyo and Osaka is the Japan, so the entire Japan, including the region and local authority and so on, should be collaborated for the sustainable finance. So expand the ESG loans also and encourage banks climate-related risk disclosures and assessment of loan portfolio was the recommendation for the banks. And the third one would be the capacity thing, the building ESG finance literacy and the capacity is also the key for the Japanese sustainable finance system. I have some printed out version of the recommendation for the this meeting, the recommendation. So I can distribute later if you want some. Please ask me. The recommendation itself is really carefully crafted because so many people were on that table. So it's better to read this rather than hearing me. So to follow up the progress, the high-level panel will be set up in the near future. I won't say when, but within this fiscal year, I am expecting. So that's about the high-level meeting on ESG finance in Japan.
Okay, thank you very much. And I think many of us will reach out to get that report as well. Now we're going to move a bit closer to where we are, and we're going to actually come back to Luxembourg. And Tom, now you launched your report just last month. One of the things that I think is of interest, we've heard about the EU roadmap. Why did Luxembourg then launch their own and work so solidly on their own, and what is a very well-crafted report?
Thank you. Well, the first thing to say is actually that we fully support the great work that is being done at EU level. I think the panel before has shown that this is really far-reaching plan, and it's really important that we have alignment across markets. But at the same time, it's also very important that we do our homework at a national level. In the case of Luxembourg, just to explain a little bit where we came from, Luxembourg has been an international platform for sustainable finance for quite some time, looking at different aspects, for instance, access to information and labeling. We have 12 years ago launched a labeling agency starting in microfinance, but which has expanded its range of labels, including climate finance more recently. Another good example is the Luxembourg Green Exchange, which was launched 2 years ago, and which has been very successful and has developed into the largest platform for the listing of green and sustainable securities, and actually do a lot of work also with their Chinese counterparts, recently launching a green bond channel between the Shanghai Stock Exchange and the Luxembourg Stock Exchange. The other aspect is the toolbox in terms of products. Luxembourg is an important domicile for SRI and impact funds. We have the right vehicles and also the distribution network, and also products in the sense of layered funds, so which are used a lot in blended finance, especially in climate finance. And finally, also coming out from this microfinance and inclusive finance environment, we have launched this year an accelerator to support climate fund managers. So that's kind of where we come from. Obviously, we want to build on that, but we want to go beyond. I think and that's where the roadmap comes in, both in terms of expanding this international platform, but more importantly, which we haven't done as much in the past, is connect the international financial with the real economy in Luxembourg and raise awareness across the industries in Luxembourg. I think sustainable finance is clearly a journey. All of us have a long road ahead of us, and as the IPCC report has shown, we need to shift up a few gears, maybe take the Autobahn over the next years. And for us, the national roadmap really is complementary to the EU action plan, because it will help us to respond, anticipate, and coherently implement what is coming out of the EU at the EU level, and at the same time, it will help us to drive sustainable finance across at the national level across the various industry segments.
Thank you, Tom. Just out of curiosity, what are the outcomes that you hope to get if you're successful in implementing your strategy?
So the strategy is, in fact, we talk about the roadmap because the strategy is really the next step. So we really need to develop the concrete actions. The roadmap gives us the vision. It was very much a multi-stakeholder inclusive process. So we involved through workshops and interview sessions obviously the financial sector, but also public institutions, the regulators, and civil society participated. And out of that came 28 recommendations that were articulated around 8 ambitions, which include education and training, research, incentives, innovation, but also data collection to actually be able to measure progress as we go ahead. But one of the key aspects to come out of this will be the launch or the creation of a private-public partnership, a sustainable finance initiative under the leadership of the Ministry of Finance and the Ministry of Environment, who actually commissioned the report with UNEP, and which will actually ensure both develop the strategy, develop actions, and ensure implementation of that over the next years. And again, it's important that it's a private-public partnership. You need the leadership from the government, but you also need the buy-in from the industry. So that was key for us. So we have two overarching ambitions. As I said, one is to leverage the international financial center ecosystem we have. So we are looking at tailoring the existing vehicles specifically to sustainable finance. Also increase the offer try and increase the offer of liquid products, especially for retail investors. A lot has been done at the institutional level, but I think there's still a lot to do for retail investors. Also connect fintech innovation with sustainable finance. We had a very nice initiative recently, a week-long boot camp for fintech companies working in inclusive finance with links to Africa. So this is something we need and want to do more. And then the other aspect is really, as I mentioned, looking slightly more inwards. So ensure that we're trying to integrate sustainable finance into financial education and especially financial sector training, so that the advisors actually can give a guidance on products. We will see with the Commission's plans for MiFID and IDD that this will come, and we need to anticipate this. But also promote research and development at the university level with M&A and MA and PhD programs. And we're also looking to promote long-term investments, looking at incentives. We have in Luxembourg, for instance, in microfinance, waived a number of years ago already subscription tax for these funds. We're looking at doing similar things for green funds, and obviously all of that will build on the EU action plan, because the taxonomy will be key to develop such incentives. So I think overall, that's in a nutshell what we're trying to achieve.
Well, I think, Tom, you're a bit humble saying that you only had a roadmap and you hadn't really thought the strategic initiatives, because you certainly were able to articulate quite a few initiatives and outcomes. So thank you. Now, the next panellist, Greg, a fellow Aussie, although he is working over here in Europe, and I've known Greg through his different career trajectories in Australia, and I think he brings a lot of wisdom to this topic, but from a different perspective. Greg, could you bring to life what you think the role of financial markets are in achieving the SDGs and implementing the Paris Agreement? A pretty broad question for you.
Yeah, in 5 minutes. Look, I think that, thanks for inviting us to speak, Lisa, and to UNEP and others, FI. Clearly, I think the role of financial markets in achieving the SDGs and implementing the Paris Agreement, obviously, a little bit to what Dr. Ma said, I think they can drive a lot of the change, frankly. If you think about what we know about the financial system, it's really the foundation of our economies, because what it does is 4 things. First of all, it mobilises capital and to allocate resources within the economy. Secondly, if you think about it, it manages and transfers risks. Thirdly, it facilitates the private sector. But fourthly, and most importantly, it promotes price discovery for allocation of resources within the economy. So I think to achieve the climate change objectives, I think does need, as we've been talking about, a profound economic transformation. And I think, again, the financial system really runs in line with its, essentially to achieve that, you've got to look at its 4 key economic functions. So, for example, if we need the system to direct capital and set prices for green and sustainable assets, especially as we know the biggest one is infrastructure, right? I think it's responsible for 60% of climate emissions. What you've got to do is make sure that you've got appropriate price signals, and I like the risk weighting proposal, because as a former investment banker, that will drive significant change, all right, about money. But also, I think the other aspect of it is about managing risks to the physical environment and the economy. So, as I say, those 4 key things, how you tweak them can actually drive a huge amount of change. And I think some of the comments have been made already. I think what we need is we need a bit more than a fast German road. I think we actually need a hyperloop, actually.
Well, unfortunately, yesterday, those that were here heard about whether we're racing towards a cliff or whether we've just taken our foot off the accelerator. So
Yeah.
I think all the vehicle stories are getting a little alarming.
Yeah, I agree.
Greg, also, what's your view on the role of finance ministers but also regulators within the system?
As a former regulator and chair of IOSCO, well, I think I'd actually say one thing. We need leadership. We need courageous leadership. That's what we need, and we've got some countries that are demonstrating fabulous, courageous leadership. It's really important. So I think first on financial regulators, I think we've got to consider the three, the main policy objectives of regulators, which I think there are three. If you think about it, for central banks and other regulators, financial stability is a big issue, really, as a former member of the Financial Stability Board. Secondly, market integrity and transparency, often a big issue for financial services regulators. And also sound market conduct and consumer protection. They're the sort of, if you think, the three big areas for financial regulation. So if you think about it, climate factors are risks. They're risks. Remember I mentioned about risks. And so regulators should be acting based on the risk to the three objectives, whether it's financial stability, market integrity, or good market conduct. Okay, risk is key. And I think under a risk response to climate change, what I think regulators need to do is look at four things. First of all, I think they've got to promote enhanced governance and risk management, and we're seeing a lot of that, what's been talked about. What the European initiative is about, partly. And I think is by using their oversight capacities, I think regulators can encourage financial institutions to identify and manage climate-related risks with perhaps even the right incentives, like risk weighting, because that will drive change. But also, I think, for example, one of the great initiatives was the FSB's Task Force on Climate-Related Disclosure. I think that was a great initiative to push investors, or to push companies to think about scenario analysis. That was a great initiative. That was leadership. That was really courageous leadership. Okay, again, a good example. Secondly, I think we need to assess whether regulatory policies and standards support climate risk management. So I think they should also augment the macroprudential framework and consider the economy-wide impact of climate factors. And I don't think we hear enough governments talking about the unintended consequences across the whole economy. Probably something we'd like to hear a bit more about in Australia, I think, actually, for example. I think thirdly, we do need much better market transparency and integrity. I think some of the things we've talked about today, encouraging greater climate-related disclosure by issuers and institutional investors. I think that, again, what's been talked about, improving the availability of ESG data, enhancing, and as we've discussed, the integrity of the green market instruments, because I think there has been a fair bit of, as a former fixed income guy, I think there's been a lot of greenwashing going on, frankly. So I think it was great, the discussion we had on taxonomy, and also what Dr. Ma was talking on China. I think that's a great idea. And then fourthly, I think regulators can promote good product integrity by providing oversight to sustainability and related investment products. So if basically somebody is offering a product that's supposedly green, but in fact it's not, you need to take action, okay, because it's misleading. But so I do think on those four areas, but equally, I think it's got to be done with an eye, importantly, on proportionality and local market conditions, because there's a lot of diversity in the space. So within markets and between countries, we're not going to have a one-size-fits-all approach, and I think that is really important. I think for finance ministries, they've got authority over the broader policy and legal framework for the sector, which enables them to set the policy directions and establish new legal requirements, perhaps at a higher level than regulators. The two need to work together. Regulators are more closer, they're on the ground. Finance ministries are at the top level. So, and I think what, again, we need to see from finance ministries, again, is leadership. We've got several forward-looking countries have done that. They've had the leadership to develop and implement national strategies for sustainable investment. And I think, the finance sector will support the climate objectives, if you actually have, if you give them the right incentives and you have clear frameworks, business will align if they've got the right policy environment and they've got the right incentives. So, but I do think that is where finance ministries and regulators can help. Number one thing is leadership, courageous leadership.
I think that's a really good reminder for all of us about it takes leadership from wherever we are and not criticising other players in the system. But if we all led, we'd get a stronger outcome. So, Jamie, some questions for you. What do you feel are the main drivers for national sustainable finance policies, and what really does change some behaviours?
Thanks, Jackie, and thanks very much to the organisers for the invitation to join you. I was watching Greg on the screen here, and with this background, I feel like we need to be weather presenters. You could point to the right bit of what's going on in Europe. Growing up in the UK, it was always raining in Scotland. So what I wanted to share is a bit of insight on what's going on, a lot of activity going on in the emerging markets. Unsurprisingly, in Paris, a lot of the conversation is about Europe and about developed nations, but this is an area of a lot of vibrancy and activity in the emerging markets. And we have IFC has the pleasure of being secretariat to the Sustainable Banking Network, which Dr. Mars played a very active role. And it's an interesting one because it is entirely emerging market-led. It's very much a market and a regulator collaboration and a peer sharing, in as much as the members are banking regulators and banking associations. So you've got a nice conversation going on, and the respective roles of those players differ in different countries. As Greg says, there is no one-size-fits-all here. And there's huge diversity in economy and growth on ESG issues. When you've got members as large as China and as small as Pacific Islands, then you've got the full breadth there. But what's consistent across them all is that as members, they perceive ESG and sustainability as systemic to their banking markets, and they see the solution to be twofold of integrating ESG risk management into their banking sectors and increasing capital allocation to positive impact assets. You might ask where we came into that. IFC, as you know, is the private sector arm of the World Bank. I'm a banker. So why are we having that conversation? We're having that conversation because effectively we're sort of the original triple bottom line investor. We've been doing this for 60 years, and in order to do our business, we developed ESG standards that have been broadly adopted. The performance standards as a framework for managing ENS, environment, social risk, have been very broadly adopted. So when the regulators came together in 2012 and said, well, how do we have this conversation? They started talking to their own banks, who were either IFC clients or Equator banks that also points to the performance standards. They said, you should talk to IFC, and that's how we ended up in this fascinating conversation. And 6 years on, the members published this report. I put a bunch out front, but they've all been swept up, so sorry, folks, they're gone. But what was interesting about this was the members collectively agreed a measurement framework for their respective progress on this front, on building roadmaps. 17 of the 35 countries have now developed roadmaps or policies. As I said, the membership's 35 countries, which is I think 43 trillion and 85% of emerging market banking assets between them. So they've got a lot to share, and they're going about it different ways, and they're at different stages in the progress. But it's to have a consistent framework of measuring progress is a big start. And they measure themselves across three pillars. One is environmental and social risk management in their banking sector. The other is growth of impact investing. And the third, importantly, for regulators, where you start with policies, is how likely are those policies going to turn into action? So what is the enabling environment to actually deliver the behavior change that we're all after in our economies and in our banks and in our institutions, which, as we all know, there's inertia in institutions and there's an inertia in people's behavior. So achieving that behavior change is hard. So some of the insights that came out of this is going to become a regular occurrence, so it will be interesting to see evolution over time. one of the insights is, as Greg said, no one size fits all. Some are going about it command and control, some are going about it very voluntary-led. It's interesting that emerging markets really is a leader on this. It's great with the new NGFS central bank network that there's a similar appetite and momentum now in OECD, but there's a great to see a emerging market-led process. It doesn't seem like wealth of nations is the driver. Actually, the poorer nations are rapidly taking this on. Collaboration is key. That public-private partnership, stakeholder engagement. It was great to see the last panel of the EU process. It's very much what's being mirrored across the members of this in terms of it does not move without bringing everyone together and on board. Although I do worry a little bit about the financial markets moving independently of the underlying economy. Unless the underlying economy is regulated as effectively, you won't get those assets driving the need for capital. Interesting, climate is often the driver politically, although there's a gap in terms of implementation on driver. I think the TCFD has been brilliant, but there is a real gap for, if you regulate and ask your banks to manage climate risk, there's a big starting point, which is, okay, what's the risks to our country before I work out what the risks are in my portfolio? And so there's an information gap there. And it's clear that the risk management side is ahead of the impact capital flows, but that's catching up very quickly.
That's very insightful. And just from that experience, do you have a view about having a very fixed way of going about it or leaving it to the markets? Do you think one method works better than the other?
No, is the quick answer. No, it is one size, there isn't one size fits all. It absolutely has to be a collaboration between market and regulation. But where the balance lies between those two sides is a function of how the financial sector in that country operates. And frankly, leadership. And wherever leadership comes from it can be okay. So you can get there any one country can get there via several pathways.
And Jamie, you were pointing out that size and the actual scale of the country doesn't seem to be the correlating factor about whether they move forward or not. So what are some of the challenges that you saw some of the countries facing?
Well, what's interesting is climate will affect everywhere. Different countries will be exposed in different ways and to different extents, but it will affect everywhere. But every country comes with a legacy of environmental and social harm that's not climate related, that is unique to that country. So, if you're in Peru, there's a lot of awareness of the impacts of mining and extractives. If you're in Indonesia, there's a lot of awareness of palm oil and agricultural land use change. So different countries have different scars, different experiences, and a different approach. Equally, different countries have a different financial system. So, investing vast amounts of time and effort to create a all-singing, all-dancing green bond framework in Fiji, which might issue one sovereign green bond in a generation, isn't worth the time, right? So, there you're talking about a different part of the financial sector that can influence and be ready for change. So it does have to be very reactive to the specific environmental and social issues in that country and to the financial markets of that country.
Yeah, thank you. What I might do is throw to the audience, because I know that some of the questions in the previous panel were about international experience. But just as people are thinking through their questions, I want to pose a question to Dr. Ma and to Jamie and Greg in particular about the potential next steps for international cooperation on these financial roadmaps. Because each of you have touched on it. It can't be just one size fits all, but you also touched on the importance of international cooperation. So, Dr. Ma.
Yeah, now let me say a few words on the few initiatives that I'm involved. One is G20. I've been co-chairing the G20 Green Finance Study Group since 2016, and now it's called Sustainable Finance Study Group. This group, I think its main function is really to convince the very senior political leaders, essentially bring the presidents of the 20 countries on board and having them to endorse the key message. We had it in the 2016 Leaders Communique. We had it in 2017, and I'm looking forward to another reference to the Sustainable Finance Study Group work in 4 or 5 days, which is in Argentina G20
So
summit.
we've got a lot of things to watch for in the next week, haven't we? With a lot of
Right.
things being published.
The second thing is the NGFS, which is the central bank and the supervisors network on greening the financial system. I'm chairing the supervision work stream of that NGFS, the network, and at least this supervision work stream is looking at 3 things. One is improving the disclosure of environmental climate information within the financial sector, of course, with some leverage from the regulators. And secondly, the risk analysis, namely the central banks, the banking regulators, and the banks and financial firms need to analyze what's the impact of the climate and environmental change on their balance sheet, on the quality of assets. And finally, looking into the feasibility and desirability of introducing some sort of a green supporting factor. In the China case, as I mentioned, it's risk weights and so on. So all of these require some international collaboration, because part of the knowledge and experiences can be shared. And also part of the inspiration can be shared. I was hoping that if China be the first mover on reducing risk weights, some of the countries may consider that as more feasible than otherwise.
Yeah, thank you. Greg, your view on international cooperation?
Yeah, look, I think 4 things. 1 is standards and guidance. 2 is convening power, bringing people together. 3, connecting the dots. And then 4 is capacity building, okay? So on standards and guidance, I think a number of us have talked about guidance, and OECD, we've developed the OECD policy guidance on investment in clean energy infrastructure. Talked about infrastructure. We've got the OECD G20 high-level principles on long-term investment financing by institutional investors, because they drive it. And then we've got OECD blended finance principles for unlocking commercial finance for the sustainable development goals. But I think a really interesting one is actually the multilateral convention we have on responsible business conduct in supply chains, which is really about multinational enterprises fundamentally doing no harm. Okay, and I think that this is one that's going to be very interesting in the long term, because this is what we're seeing is the crowd, which is consumers, investors, are very interested today to know about where their products come from, and increasingly are asking, or institutional investors, as we know, are asking their companies, what do you do in your supply chain? So, what harm or not are you doing? And this convention, again, signed by 47 countries, it actually has a national contact point in each of those 47 countries where consumers, investors can complain if they're not seeing the right thing happening in another country. So I think it's a very powerful instrument, and one of the things there, for example, we're looking at now is how you can use distributed ledger for a consumer to actually check along the chain to see just how well a company is being responsible. And I think these sort of things are really important. On convening, bringing governments, policymakers together, clearly we do that, bringing, for an exchange of views between either policymakers or policymakers and industry. We do it here in Paris, but then we do it in Africa, Asia, and Latin America. We just had our annual forum on green finance and investment, where last week we had 600 participants. On the issue of connecting the dots, I think it really is important we connect the dots in terms of other international organisations and make sure we don't duplicate, and we actually connect the dots well. But not just across finance. I think linking in the environment, development finance, and even what happens in cities is really important, right? And then finally, capacity building. I think what you're talking about with developing countries, what IFC is doing is great. I mean, that because they can drive a lot of, actually they're usually often ahead of the game, right? So I think that is important, but also just providing, capacity building, I think is really important. And we are making, starting in January, funded by the Danish, we are going to have a new program which is called Clean Energy Finance and Investment Mobilisation. We're going to be looking at 5 key countries around the world and in emerging markets where what can they practically do to try and move the dial in terms of climate change. So I do think there's a lot to do. But importantly, across here, it's important we all connect the dots. Really important. Yeah.
Yeah, good systemic thinking is required. And I'll come to the final panellists once I take some questions from the audience. Questions for any members of the panel? There's a question over here. If you can say who you are and where you're from, and then your question.
Hi, sure, of course. I'm Sony Kapoor. I run an international think tank, Redefine, and I was a special advisor to the UNEP inquiry. So a question for Margin, maybe also for the other panelists. So a lot of policy measures have been tried, and you spoke about a whole plethora of them. Not enough time has passed, but some has. Do you already have some ideas on which of these are the most effective, and would you be able to do a little hierarchy of 1, 2, 3, and maybe the other panelists too?
I'll ask you to start, Dr. Ma.
I think the most effective policies are not yet there. I'm hoping that if the risk weights can be reduced for green, it's going to be the most powerful one. By far more powerful than any other green finance policies that have been put in place so far. The other few instruments that we have tried, I think, are working, but to a limited scale. For example, interest rate subsidies, which is now introduced by some local governments, but it's subject to the constraint of the local government fiscal capacity and willingness. And the other thing is about central bank re-lending facilities. So far, we require the banks to present green loans and green bonds on the balance sheet as collateral. So collateral itself is a constraint as well. So each of these instruments have a limitation, but I'm hoping that the risk weights can be a much more powerful cross-border cut to the financing, as well as the potential extension of more green loans on the back of a lower capital requirements. The other thing which could be very powerful when we fully implemented it, it's the disclosure. The disclosure thing is changing mindsets of everybody within the financial system. For the companies, once you disclose good green information, you actually are treated very well by the society, by the consumers, by the financiers, by international community. This kind of benefits will show up, I think, more and more visibly in the longer term, and they will be incentivized by the mechanism itself. But so far, very few countries has introduced the full-scale disclosure requirements. I'm looking forward to that effect in 2 to 3 years' time in China when we have implemented this compulsory disclosure requirement to all listed companies.
Thank you, Dr. Ma. Any other comments from any other panelists? Marco, any comment?
I think the characteristic of the Japanese policy is very much on voluntary approach. So we do not expect that the regulatory body will introduce the regulation for the disclosure, for example, but they rather encourage the industries to voluntarily disclose their information. To do that, the government prepares every guidelines and guidance tools and everything, and make them, I don't know, raise to the top. Yeah. So it's very effective actually because they voluntarily do that because they want to be the number one, and I think it's an effective way to implement that thing.
Thank you. Tom, would you have a view?
I'll leave this one to the policy experts
to,
next to
Greg.
me. I think it's easier.
Greg definitely will have a view.
Yeah, I do have a pretty simple view. I actually tend to agree with Dr. Ma. I frankly think there's really two things. One is the market price signal, okay? Whether it's a market price signal through risk weight changes, you will turbocharge. As an ex-banker, I know we both know that we know that if you tell the market that actually you get a 50% charge, I can assure you that you will have lots happening in this area. Also in transparency, I think it's very powerful. Let's not ignore the power of the crowd today. And the more information the crowd has about the risks of climate change, the more that they will agitate and put pressure on companies and institutions to actually do something about it. So don't forget the crowd, because frankly the crowd today is more powerful than government. So I think this is really important, the crowd. And then I think that the third thing I think actually is the I know it's really, I was going to say education I think is really important. Education about the risks, I still think there's a lot to be done, whether it be in schools or in the broader community. I think it sort of fits in with the crowd, but I think education is still really important. People really still they think short term, they don't think long term. I think the more probably, I hate to say it, the more probably you can scare people, probably the better, frankly. And I think governments could do a lot more in terms of almost media explaining and saying, we're actually in for a big disaster if we don't do something. And I think, frankly, also I don't believe in voluntary, I believe in mandatory, frankly, because I think we're beyond voluntary now. I think we've actually got to move to mandatory, frankly. Sorry.
But I think you're talking even more broadly about financial literacy. Generally in the population is fairly critical, linked with that education point. Jamie, your view and answer to that question?
Just one, I agree with everything my colleagues have said. One nuance I would add is to differentiate between broader sustainability and ESG, which is broad, deep, and complex, and climate. If we're on the climate one, I fully agree in terms of the signals to banks on their pricing, but equally I would encourage that we don't forget where we all started, which is a carbon pricing signal. Don't over-rely on, let's not become masters of the universe and assume financial engineering solves what is a broad economic problem. So a carbon pricing signal is still the best thing. And the banks and the financial markets will respond. When it comes to broader ESG, which you can't simplify because it's not a fungible ton of CO2 equivalent when you're talking about biodiversity or local communities or all of the other broader aspects, then transparency, disclosure, transparency is the only way to get to the nuances of that to ensure that capital's being allocated with due care to risks.
Thank you. So some consistency on disclosure, but not on whether it should be mandatory or whether it should be voluntary. So thank you. We are out of time. I'm getting the time signal. Really if we can thank the panellists. So I think it was some brilliant content and a lot for us all to think about, and particularly this connection of acting in an internationally connected way, but still considering local markets and local market needs. So thank you, and we'll make room for the final speaker.